Everybody, welcome into another edition of Market Takes. Listen, I know you could have been anywhere in the world, but you're here with me, and I appreciate that. I am Dion Rabouin, reporter at the Wall Street Journal. I know we left you for a little bit too long. Last Market Takes was like last Monday. I've heard a couple y'all in my email inbox talking about what's going on with Market Takes. We are back. I wouldn't have ever left you without letting you know, without saying goodbye. So listen, today we are diving into the latest jobs report, the jobs report from August. It's the first day of September, and already we got the jobs report. We don't even have to wait. It's a beautiful thing. We saw addition of jobs this month, a big increase, 187,000, which actually was the same as what we added last month, but things have gotten a little bit sticky. I'm going to talk about that in just a second. So listen, here's what we're going to talk about on today's Market Takes. We're going to talk about what the report said, how that compared with expectations, and also get into a trend that I've noticed on the jobs report that I don't hear anybody else talking about. It's been going on all year. We're going to get into that. We're going to talk about some standout numbers in the report. There were a lot of things that really kind of snuck below just the headline numbers in terms of the inflation or the unemployment rate and the number of jobs added. We are going to talk about those. Of course, we're going to get into the market reaction, how stocks, bonds, currencies, commodities, all those things responded to this report. And of course, we're going to talk about the current market focus, how investors are viewing this jobs report and how this sets us up for what's coming next in terms of other data. And of course, we're going to look ahead to the Fed's September meeting. That meeting is coming in less than 3 weeks, so we're going to get you ready for that in just a minute here. And of course, we're going to talk about what's next because we are always looking forward here on Market Takes, even though it is backward looking data. So without further ado, let's get into it. The U.S. economy added 187,000. It's 187 for the month. Let's throw a chart up here on your screen just so you can see what we're talking about in terms of the number of jobs we've seen. So there's a couple things that stick out here. Number one, you are seeing consistently lower highs, right? You see that number in February 2022. That was up near 1 million. And we have seen the highs as those jobs have jumped up. In successive months, they haven't been as high. You're also seeing lower lows. I think really interesting. The data we got today again added 187,000 jobs in August. That was more than expected. The expectations were for 170,000 jobs to be added, the unemployment rate to be 3.5%. The rate was actually 3.8%, but let's stick to these job ads numbers. Now, what you're seeing is July was revised down to 157,000. The original report said 187,000. Well, it got revised down to 157,000, and June was actually revised lower by 100,000 jobs. So you're seeing now that June number at 105,000, that's the lowest, the weakest month of job gains since December 2020. The other thing that you notice here, now that we've had those revisions, right, all those months have been revised lower, June revised lower, July revised lower, and then we got this report for August, you see the number of jobs starting to pick up again. Now, one thing I want to talk about, and really what this chart illustrates, is just a trend that I've been seeing. And I went to the BLS, the Bureau of Labor Statistics website, because I was like, am I crazy or am I seeing what I think I'm seeing? I'm seeing what I think I'm seeing. We have consistently had lower revisions. Every single month, it seems like the job numbers comes out high when we get that first report. It's, something high, 187,000 like we got this month, or 187 like we got last month, or 185,000 like we got in June. And then when the revisions come out, it's lower. And then the next month comes out and that previous month is revised lower. We have seen that every single month this year. I'm on the BLS website right now. July revised lower by 30,000. June revised lower by 104,000. Every single month this year has been revised lower. So every month the BLS comes out and they said, okay, this many jobs were added. They send out a bunch of surveys to jobs, to employers, to people. They make calls. They say, hey, how many people do you have working there? Give us your headcount numbers. Probably 50 to 60% of those people get back to them by their deadline so they can get the report out by the time that it's expected, which is today for August. And usually it's the first Friday of the month, unless it's something crazy happens, then they push it back to the second Friday. But usually by that first Friday of the month, they got to have the report out. So they have to have the responses back by about the second week in the preceding month. Now, more of those come in later on and they follow up and they come back to people and they say, hey, are you sure about this? What's really happening? And what we've seen every single month this year is previous months have been revised lower. So overall, June has now been revised lower by 104,000. May was revised lower by 58,000. April revised lower by 36,000. March by 19,000. February by 63,000. January by 45,000. So every single month this year now through July has been revised lower, meaning that number that we first got, that when the market reacted, when things happened, that's been wrong and it's been overestimated every single time. Now that's a little strange. Usually you have some higher revision, some lower. Generally it comes in around the same, you see the same trend, but I thought it was a little strange that we've seen every single month revised lower. I went back and I checked the numbers. We have never, and I went all the way back to 1980. I couldn't keep going because these reports are a little bit cumbersome, but going all the way back to 1980, that's 43 years ago, there has not been one single year when we've had net negative revisions for the year. And we have had negative numbers every single month this year. The one revision that was positive was March. It was revised higher by 52,000, but still March overall was revised lower by 19,000 because the previous month before March had been revised lower by so much, or the previous revision had been lower by so much. Here's why that matters. When investors are making their plans, when they're buying stock, when they're saying, okay, the US economy is doing this, here's the trend, here's what's going on, they say, okay, well, what we've seen is this, and so we're seeing a moderation. We're seeing a much greater moderation of job gains than what we expected and than what was initially reported. So when investors are saying, okay, jobs went up by 187,000 in July, well, now it actually turns out it was only 150,000. And what you're seeing is that increase now. So we had 105,000 in June, 157,000 in July, 187,000 in August, and now you're starting to see new trends emerge because of those lower revisions. Those lower revisions also have the tendency to not only kind of change the trend, but we're seeing now consistently lower job growth than what we had expected. Now, that's good news for the Fed, but it's also a bit bad news because the economy is maybe not as strong, not as healthy as what we had been expecting. And it seems like consistently month after month, we see that the economy was less healthy, that jobs were less robust, that there were less employment gains added than we found out. And it doesn't just seem that way, that's what it is. So when the BLS goes back and they say, hey, here's what's really happening, they're consistently finding that there were lower jobs growth, less or fewer jobs added, lower jobs growth overall. Real quick, let's talk about the unemployment rate. That rose to 3.8%. Also, the number of unemployed people increased by 514,000. So 514,000 more people. That's 6.4 million unemployed people. We've also seen an average gain over the last 12 months of 271,000. Last year at this time, it was 483,000 average gains, average monthly job gains. So we have about halved what we were doing. Not quite halved, don't at me, math nerds, but down to 271,000 from 483,000 added up each month a year ago. That's a significant decline. We have seen a significant decline, and like I said, it's really come from those revisions. So we've been moving consistently lower in terms of the number of jobs added, but we're not finding out just how much lower until 1 month, 2 months, 3 months later. So again, we're finding out about June and how weak that month was, the weakest month of job gains since December 2020, but we're just finding that out in September. That's an interesting theme and something that I'm gonna call up my folks at the BLS and ask them about what's going on, why has the job data been consistently wrong all in one direction. That's unusual. Another big takeaway from this report, though, that I want to make sure and point out is we are seeing the labor market slow down, but maybe the BLS needs to slow down in its reporting. Also, I think what really stands out, though, again, is that increase in unemployed people. We are also seeing an increase in labor force participation. Gonna talk about that in just a minute. So let's talk really quickly about the Fed and what they want to see and the number of jobs added versus the number of people looking for a job. I want to put a chart up here on your screen so you can see just what we're talking about, see kind of an illustration of that trend. This is what Fed Chair Jerome Powell is talking about when he's talking about the number of job openings versus unemployed people. Job openings have been consistently coming down. We see that in the JOLTS report, the Job Opening and Labor Turnover Survey. You are seeing now a very solid, consistently downward number. That's that red line right there on your screen. You see it moving down with a vengeance. It's really moving clearly in that downward stance. What you're also seeing now is a pickup of unemployed people that we had not seen for a while. That's largely been because a lot of folks had just not been in the labor force, but now you see an increase, and you saw that the unemployment rate rise 3.8%, and now the number of unemployed people is rising. If you look back the past 20 years, we had really never seen this theme before of more job openings. This is more people trying to hire folks than there were unemployed folks to hire. That had never really happened going all the way back to the history of this data. And now we're seeing it consistently over a longer term period. And the Fed has really focused on that and said that's a big problem for the economy. It's keeping inflation high. It's going to keep inflation from coming back down, and that's something we need to deal with. This now shows that that problem is being dealt with. Finally, after a long time after the Fed raised rates at the fastest pace in at least 40 years, we're seeing now those things start to come into harmony, but as the economy slows down, maybe that's not such a good thing. So listen, this chart is illustrating the theme that we're seeing and the trend that we're seeing in terms of job growth and in terms of the number of people looking to hire folks, the labor force, the labor market coming back into sync, as the Fed might put it. But that's not good news for you and me. That's not good news for job seekers. That's not good news for, your cousin who's sitting on the couch unemployed trying to find a job. The job gains and the opportunities aren't really going to be there, and it's looking like things are coming in a negative direction in terms of labor market. But again, the market really seems to like it. We'll talk about that in just a second. Fewer hires and separations in the previous month. The market loved the JOLTS report when it came out because, like I said, this is exactly what the Fed wants, and it's supporting the narrative, that jobs growth is slowing, that the labor market can get back into sync. Whether or not that's a good thing for average working folks, it's not. But it's what the Federal Reserve wants, and that means that maybe they don't have to raise rates as much. They don't have to rein in and slow down the economy quite as much. That is a good thing. One big surprise number, I talked a little bit about the labor force participation rate. That rose by 0.2 percentage points to 62.8%. That labor force participation rate has been stubborn. You want to see that rise because you want to see more folks coming into the market. Those folks have really just been off on what they call the sidelines. Folks who are saying, they don't have a job, but they're not looking for a job. They're doing something else, and they're not coming out saying, I'm trying to find a job actively. And so the Bureau of Labor Statistics just categorizes those people as out of the labor force. There are only three categories of people in this world. There are employed people, unemployed people, and those people who are out of the labor force. And if you're out of the labor force, you're just kind of not thought of. Now we've got about 37% of people, a little over 30% of people in the US, that's retired people, that's people who are under the working age, that's people who are disabled, it's all those folks, but it's also just people who aren't looking for a job for whatever reason. Maybe they've got a situation, living with mom, living with a relative, something like that where they don't need a job, but all those people are not working right now. And that number is starting to pick up, and that's what the Fed wants to see, because as those people come back in, they can fill those jobs out, and then you start to see maybe less pressure on the side of employers to maybe pay more, because these people haven't had a job at all. So anything is better than nothing, and so they're not really pushing those wage gains up higher, which isn't pushing up inflation, which means inflation can come back down. Those wage gains can get kind of back into balance. At least that's how the Federal Reserve thinks of it. It's very unusual, though, I will say, it's very unusual to see an increase in labor force participation and also an increase in unemployment. Basically what that means is someone who hasn't had a job for a long time or hasn't been actively looking for work for a long time is coming in and saying, well, I don't have a new job, but I'm unemployed now. I'm officially unemployed. I'm just telling you this because, you called me, the BLS calls folks and they say, hey, are you unemployed? Are you looking for a job? And now what we're seeing is an influx of people who are saying they're looking for work, but don't have work. Usually when the labor force participation rate goes up, it's because people have found a new job. They say, oh yeah, I got a new job. What they're seeing now is it's picking up just because people are saying, yeah, no, I'm looking for a job now. I don't have one, but I'm looking. Very unusual, doesn't really happen, and definitely something to keep your eye on. Listen, let's talk about markets. Let's take a look at what's going on in the markets. I want to throw a chart up here on your screen and show you what's happening right now overall in markets. You're seeing the stock market really rise. The Dow has been up strong. The NASDAQ actually got negative for a little while and is now back up positive. We're seeing the S&P 500, the overall market index, up about 0.5%. Really interesting response that we got from bonds. I want to throw that up here on your screen as well. Look at that huge jump in the 30-year bond. It's only up 6 basis points, but that big move, this happened right after the jobs report came out. You saw the same thing in the 10-year, kind of went down negative initially, but then boom, jumped right back up. But you don't see that same kind of response from these shorter dated notes. Look at the 7-year, you see the same response, but not by as much. And as you go down the yield curve, as you go down to these shorter dated maturities, you're seeing it lower and lower to the point that really it was still negative for the 3-year, for the 2-year, and across the board on these shorter dated yields. So that I think was really interesting, the response that we got there from the bond market. Currencies, you saw the euro turn negative. That means the dollar strengthened. Basically, the dollar strengthened across the board. This is showing us signs that folks expect inflation and growth to continue to pick back up. And that's, I think, just on the headline number, increased jobs, more jobs added than expected, 187,000 versus 170,000. And like I said, the market reaction right now just illustrating the overall theme that we see in markets, which is just that, growth is going to continue. Inflation may be higher for longer, and the Fed may have to do a little bit more work. But there's not a lot of conviction. You don't see the bond market selling off. You don't see stocks selling off. In fact, stocks are positive in the green. So this suggesting that, the economy could be doing a little bit better. But as you said, when we dive into those numbers, really digging into the report, it's a little bit more of a nuanced, complicated picture. I think that's why the market doesn't have a lot of conviction one way or another. Listen, let's talk about the current focus on the jobs report, how the market is thinking of it. Investors want this soft landing summer that we've had to continue. We have seen, though, some deterioration in business sentiment and consumer sentiment. Last consumer confidence report we got from the Conference Board was ugly in terms of what people think about their current situation and the future. Not good. But it is still all about inflation, which is cooling from the highs, but we are seeing inflation be a little bit stubborn. Let's put another chart up here on your screen really quick so I can just show you what I'm talking about when it comes to inflation. As you see there on your screen, inflation consistently coming down. Now, I usually show you the CPI, Consumer Price Index. I'm showing you the PCE, Personal Consumption Expenditures, which is the Fed's favorite gauge. This is what the Fed says they watch, right? I'm showing you this for a reason. Now, the CPI, we saw it was a little bit higher, went up over to 9%, and usually see those big pickups over 9% when we look at the CPI back in 2022, and then coming down. We see the same theme here from the PCE, but it's lower. And as we get towards these readings, it's been consistently lower, but now it's matching up almost exactly with CPI. The past two numbers have been almost exactly the same on CPI and PCE. Now, why does that matter? CPI and PCE are different indexes. They measure things differently. And the reason the Fed prefers the PCE, number one, it updates its basket more often, meaning what people buy changes. People are buying more of one thing, less of another thing. Remember during the pandemic, folks were buying a lot of stuff in terms of we're stocking up for what's going to be in our house. We're doing cooking at home, all those things. We're doing a little bit less of that now. We're going out to restaurants and bars, things like that. So those baskets change, and the PCE updates that more often than CPI, right? You also see things like medical care gets a higher weighting. Housing plays a much larger role in CPI than in PCE. And that's a big part of why PCE is important right now, because the PCE index adjusts for things like when folks are buying steak and then all of a sudden, wow, man, steak is getting too expensive because of inflation. I'm going to switch to hamburger. Well, the CPI doesn't account for differences in steak versus hamburger. The PCE does. It also has a much bigger appetite for changes in things that people buy rather than just what they spend on housing and transportation. It's a lot more about how businesses are responding and changing things. So PCE being right up next to CPI, that's interesting, and it also takes away the opportunity for the Fed to, when they are leaning towards making a hike pointing to CPI, but when they're leaning towards stopping rate hikes and maybe turning around pointing to PCE because it's lower. Now those two gauges are basically exactly the same, and you're seeing a pickup in inflation in both CPI and PCE. So that pickup means inflation is being stubborn. It's not consistently moving back down toward the Fed's 2% target. And this chart really just illustrates that stubbornness, right? The fact that inflation isn't just going down in one consistent line. It's not linearly moving down. It's picking back up. I want to read you a real quick quote from Fed Chair Jerome Powell. He talked about the labor market. He said, quote, "Evidence that the tightness in the labor market is no longer easing could also call for monetary policy response." Basically what that means is if we don't see number of job gains going down, if we don't see those job openings going down, if we don't see unemployment picking up, we may have to raise rates some more. This report really suggests that the Fed is in a good place, that the market is doing what they want it to do. Again, not so great for you and I, not so great for job seekers out there, but good for the Fed is in they don't have to raise rates likely. The market is saying, they're looking out and they're saying a 93% chance the Fed doesn't raise rates in September and about a 70% chance that there are no more rate hikes this year in terms of looking forward at the Fed. So really quickly, let's talk about that September Fed meeting coming up the 19th and 20th. Of course, we'll be right here on Market Takes. We hope you'll join us. We break that meeting down on September the 20th at 4 p.m. But the JOLTS report really reduced, and the market saw that and they said, okay, Fed's not hiking in September. We're pretty sure. This report today really locked that in. The JOLTS report kind of increased the likelihood there were going to be no more rate hikes to about 80%. Now, with this report, it's over 90%, 93% chances that when we look at the Fed funds futures market, there's going to be no rate hike this month. And really out through the end of the year, odds that there's going to be another rate hike have been reduced. 70% chance investors see that there are no more rate hikes through the end of the year. The big question, though, is just going to be about Fed's summary of economic projections. Do they predict they're going to raise rates again, or do they say, you know what, we raised rates once a couple months ago, we're done with all that, we think the economy is cooling down, doing exactly what we needed to do. This jobs report today suggests that they could do that. The question is, will they? What is the Fed's bias? What are they thinking? How are they moving? We're going to find out on the 19th and 20th of this month. And we'll find out on the 20th when Fed Chair Jerome Powell does his press conference, and we're breaking it down here on Market Takes. Listen, the Fed's Beige Book is out on Wednesday detailing the economy. We are going to dive into that, talk about small business, talk about how the economy is doing, talk about job gains, talk about job losses. We are going to get an in-depth look at the economy on Wednesday, 4 p.m. right here on Market Takes. We hope you'll be there or be a... Don't do it. Don't be a square. Anyway, I'm Dion Rabouin for the Wall Street Journal. This has been Market Takes. We hope you will join us next time we do it again.